Hey, everybody. It's Joel Kennedy with the ConsumerFi podcast. I apologize for not being there every week. We're getting into the holidays here, but I'm going to make it worth your while. We have Michael Buckingham, who's with JD Power. Michael, welcome to the podcast.
Hey, thanks, Joel. Thanks for having me this Friday.
Yeah. So folks that know me know that I really grok any kind of data, market data, market surveillance reports, all those types of things. Michael, I sat through some of the other, overall market presentations and some of the conferences, but I had the luxury of being able to sit in yours at Used Car Week. I had not known you. I had not really sat through, I think, many of your presentations, but I was really stoked to hear the presentation and how you broke down all the statistics, because there's so many things that are just quite different than what we've seen in the past. And so I said, Michael, I got to have you on the podcast. So thank you for.
Well, thanks. And I do have to say, at JD Power, I have a large supporting cast that helps me put everything together, Joel.
I know you do. And I want to know about that. So Michael, tell me about tell us a little bit about yourself and kind of the cool stuff that you guys are doing at JD Power.
No, sounds great, Joel. So for folks that don't know me out there, Mike Buckingham, I'm the practice leader at JD Power. I manage our PIN Navigator group. PIN, if you're not familiar with the acronym, is our Power Information Network. We've got a couple of products in that set. The one I manage is PIN Navigator. There's another one called Explorer. High level, we get data from a large population of U.S. auto dealers. It pipes through their DMS system. So in the finance side, we know all kinds of transactional data, from buy rate to sell rate to loan terms to market share by lender, and as you can imagine, the DMS. On the auto side, a lot of data that we drive out on transaction prices and incentives and trade-in values and things like that. The presentation today that Joe and I are going to talk about is really a combination of a few legs. The PIN Navigator, which is originations data. We partner with TransUnion, and if you need portfolio data, I've got to steer you to TransUnion. But we have the origination data. We also, from our PIN Explorer and forecasting team, just have a wide variety of data on the new car market scene. Some of you may know JD Power. Probably about 5 years ago, we purchased the NAD Used Car Guide, and then in about the last year, we also acquired ALG, the residual setting company. So, and part of my presentation, when I speak to the used car market, and Joel may have some questions, we'll really drive off of Jonathan Banks and the used car team, and Eric Lyman and the ALG team, and really puts together. And obviously, I impressed Joel. I hope I impress everybody today.
I think it's great just to have these different points of view, different perspectives. Sometimes it's, your data sets are just a little bit different, and it's a nice little hack to be able to see all points.
Yeah, so, and for us, Joel, I'll just throw in, I mean, we're real-time data. We refresh, we get data from the auto dealers every day, and obviously auction sources and things like that. We're seeing, so our data is very, very current.
Yeah. Great. All right. So for folks that are on the audio only presentation, we're going to walk you through what we're talking about. But if you're watching this on YouTube, we love you. And thanks for checking out YouTube, but you'll be able to see the presentation. For folks that are hearing this and say, geez, I'm a visual person, I'm not going to mess with YouTube, Joel, you're annoying me. You know what? I'm going to make it easy. It's michael.buckingham@jdpa.com. Shoot him an email. Guys, we're working from home, but it doesn't mean we can't pick up the phone, give people a call, shoot an email. He'll send you the deck. He's happy to do so. Cool. So, to start off, Michael, here, I'm gonna go to full screen here. Yeah. There we go. We started here. This one I just kind of zeroed in on because there's a story, and the story is this. The story is right here in this kind of the daily selling rate.
Uh-huh.
Yeah, I mean, because you can see that we had some strength here. and then it's starting to come down. Whereas every other thing we're looking at, new retail inventory is obviously scarce. The wholesale values are driving the grosses. The dealers are making a lot of money. Incentive spending way down. If you're a buyer, not the best time to buy a car, maybe unless you had a trade that you can make a lot of money off, and then it just kind of equalizes. But this daily selling rate was the one that I said, okay, there's a story to tell, because we saw 2020 was, in 2021 we had some strength, and now it's starting to come back down to earth.
Yeah. I'd say, Joe, probably the biggest key on that slide is if you look at the top middle and the new retail inventory, really, really falling dramatically. I sat in a meeting yesterday. We now looked at November data. I think this is September data we have up here. We see the average inventory is about 25 days industry wide. And so when you have low inventory, clearly affecting the daily selling rate, dealers have nothing to sell. You pointed out with nothing to sell new, and we'll talk about used cars later. If you don't have new vehicles to sell, well, then you need to get used vehicles and sell. And that's why the trade-in values are so high, because dealers are buying up all the used cars they can. They've got to stock their shelves.
Yeah.
If you look on the bottom, really a couple interesting dynamics. Incentive spending per unit. When the manufacturers have little inventory to sell, how much incentives do you need? You can see it's falling dramatically. And if you look at the bright blue, you can see the uptick last year where we were in COVID, and then all of a sudden you poured money on to try to stimulate the business.
Yeah.
The middle one, consumer-facing transaction prices, they continue to grow. Some of it due to mix. I mean, we are a truck and SUV-centric market. As I like to tell people anecdotally, if you're a large manufacturer and you have two chips, are you going to put them in a $60,000 or $70,000 plus vehicle, or are you going to put them in a $20,000 vehicle? And I think we all know the answer.
Yeah.
Then the right-hand side, vehicle gross, just off the charts. This slide is data, Joel. Again, with September, we now show about 99% of all new vehicles sold are sold at or above MSRP. There is virtually zero discounting.
I believe it.
Gross profits are very strong, and you've got some selected vehicles. It was mentioned on our internal call yesterday, a Kia Telluride, for example. A lot of dealers are getting $10,000 over list price. If you're familiar with Mercedes G-Wagon, the market is now $100,000 over MSRP.
Man, you got to be an enthusiast to kind of buy at those prices. I don't know.
Crazy, yeah.
I don't know. I'm just popping through these slides for folks that may not be seeing the visuals. But what was that prior slide? Let me see if I can go there. Yeah, so we were looking at sales performance for the month of September. This is still new. We'll get into some used and then some other origination, wholesale, and then origination. But sales are down.
Yeah. We saw overall, and when we track the industry on a year-over-year basis, and this was September, and we're seeing similar patterns emerging for October and November. Sales were off 25%.
Right.
Non-retail were down 31%. Again, I go to the analogy about chips and inventory. If you're a large manufacturer, you have limited supply to build. Does it go to your retail dealers, or does it go to the dealer rental companies? And I think we all know the answer right there. It's lower margin business, those non-retail sales. So that's been falling. Demand is back with the rental car companies. I think people are back traveling, but they're on tight supply.
Yeah.
The SAR fell to 12 million units, and that's the annual selling rate. About 4,000 units below last year. Non-retail, again, was off 31%, and really that accounted for 11% of the 25% industry sales drop off. So
and then
retail was fairly well. It's not as bad as that headline number.
Yeah, we're trying to, and year to date we're doing better than 2020, so we're kind of heading in the right direction. Yes. That was a big theme I definitely picked up. Talking about the different makes and models that people are buying, Michael. Yeah, this is a great graph, so you can kind of see where we're kind of growing and then where we're declining.
Yeah. As I said before, I mean, if you look at the segment share, on the monthly side or on the year-to-date side on the right. I mean, we are SUV and truck centric, top vehicles, mid-size SUV, compact, large pickup, small SUV, then compact car is about in the 6th or 7th place right there, holding steady. Some of this, Joel, when we look at it is, again, it's not as, what's deceiving about some of these charts is they don't speak as much to consumer demand as they speak to supply in the pipeline.
Yeah.
Right?
Yeah.
And spot shortages. Some are better than others. I know, article in Automotive News this week talked about Subaru is just, they're on a 5-day supply of vehicles. They are so backed up. They're basically on order to delivery right now. They have no inventory.
Incentives we mentioned earlier, way down.
Falling like a rock. And you can see the 3 prior periods. You had some seasonality. You see the uptick in 2020 when we fought back COVID soft sales. You can see, the incentives again. That's our walk chart. It's not segment mix. It's really just incentive value. It's dropping, and then relative to MSRP, we've been traditionally in years past anywhere from maybe on a low of 8% to about a high of 12%. Is the average incentive spend as a percentage of MSRP. You can see it's almost down to 0 now.
Yeah. I sometimes wish that I was in college studying economics during this whole thing, because it would be so easy to put together graphs and charts and reports, because it's all just so obvious that the fundamentals of demand and supply at play here. Right. Why am I going to give incentives if I can charge people well over MSRP?
Right. You don't need to move the market when you have a limited inventory. That probably is the easiest way to say it.
This next one, we're looking at the transaction prices, Michael.
Yeah. And this is a good one to really, we do it in 3 pieces. The obvious on the left-hand side, you can see the average new vehicle. And this is the consumer-facing transaction price. This is not MSRP. This is what the consumer actually signed up for or wrote a check for. These numbers almost at 44,000, 43,000. In the middle, we talk about the walk on a year-over-year basis. Why did it go up from 36,000 to 44? And you can see partly segment mix, vehicle cost, much lower incentives. But then look at the last bar, dealer profit. Dealers are just not discounting the vehicles.
Which, I when I look at what they had to deal with in 2020, I hope there's a little bit of, making up for lost time.
Right. The last one, Joel, let me just point out to you, if you can go back a second. If you look at that chart on the prior page, you can see the consumer-facing transaction prices relative to MSRP. We've got 3-year periods, and you can see one of them starts to climb, and that's actually 2020, where's demand. But if we look at 19 and 18, the average consumer paid 84% of MSRP when it was all said and done, after incentives and things like that. Now we have approached 99%, and we're more than likely going to cross it because vehicles are being sold above MSRP.
It's unreal.
Yeah, never seen before, Joe. No one has ever seen this.
So here we have like kind of an overall scorecard, Michael, that I really like. What do you see as the big takeaways on this one?
Yep. Again, strong retail sales versus 2020. We are concerned about the inventory the remaining months of the year. We're down to now December. We're going to be up a little bit. Huge lift in transaction prices, record-setting dealer gross profit. There's never been a better time to be an automobile dealer right now. Touched on before, huge reduction in incentives. And we do see a declining lease mix. At this period on a year-to-date, we were showing leasing was about slightly less than 25% of the market. Our November data shows us leasing is now down to 20%. Leasing has a lot of incentives in there. Partly the manufacturers have cut back incentives, and partly vehicle sales. It's a mix. How much is available out there. We see the vehicle, the lending terms continue to increase, aiding affordability. We see subprime originations are compressed. They've not fallen off the map, but there is less subprime as a percentage of the total. The loan values, though, this is the interesting one. When I tell you that transaction prices are up 20%, the first thing you're going to say is, well, gosh, I guess the lenders must be doing a lot of over advances, and that is absolutely incorrect. The reverse has happened. The loan to values that the lenders are providing their consumers are actually dropping, and that's amazing. A huge piece has to do with that the trade-in equity, much improved trade-in equity right there.
Yeah, that's one that I think for me is kind of the risk-based canary in a coal mine. And if we can control those LTVs, I think it strengthens the portfolio quality for the paper holders.
Terms are a little longer, but I would say folks that have been around a long time, whether you make a loan for 60 or 84 months, the average consumer somewhere around month 42 wants to trade in. So we're not losing customers for 7 years and keeping them out of the market. Consumers are going to trade. It's really just an affordability play.
Yeah. So I like this summary slide, Mike, where you kind of looking at the kind of overall year.
Yep.
This is a good one to finish on.
Clearly, production driven sales. No demand shortfalls forecasted due to limited. This is we know we have, and that's when we back up that 14.1 in retail sales with a total of 16.4. Retailer profit, I touched on, likely the best ever. I mean, it is the best ever. We just haven't closed out the year. And then for the OEMs, likewise, the great profit out there. They've never had numbers like this before. Very, very profitable for the auto manufacturers. There are some spot concerns out there. You have certain brands that have really been capacity constrained, but overall, in the big picture, the OEMs are very profitable, and you can see it in their stock prices.
Michael, I don't know if we talked about this, but I think about the supply chain issue, but then there's also just getting the delivery of units and parts and all those things. And I know we have this backlog with ships that aren't able to come into harbor.
You've got some of that. One of the things, and I'll use, I'm in South Orange County, and a few days of the week I can see container ships offshore, and they're probably 30 miles from the Port of Long Beach. Typically, the car carriers are going into unique ports. I think everybody's aware of the Port of Long Beach in California, the LA port. It's Port Hueneme, which is about 40 miles north of LA, where the cars come into. They've been getting off pretty good. The only thing I would say, Joel, is you do have some delays with train, and you do have some delays we're hearing about trucks. It's a great time to be a long haul truck driver because there's a huge demand for those people. The chips are the big driver. You've still got some issues with some of the suppliers. You have to think, basically, 14 months ago, the suppliers who build so many components and so many pieces of these vehicles, I mean, they basically shut down for 3 months, and then everybody at once came on board. It's just like everybody leaving the parking lot of a football game. It takes a long time to clear itself up.
Golf ball through the hose, if you will.
Yeah, absolutely.
So for our used car enthusiasts, we're going to start getting into it here. We're looking at a slide showing the J.D. Power used vehicle price index. And if this was a stock portfolio, I'd feel pretty happy.
Oh, yeah. The one thing for your audience, Joe, if they may see, I would say different views, when we look at this index, we go back 8 model years old, up to 8 model years. Some you'll see some charts out there that may have all the vehicles, but we look at more of the current, the current year used back to 8 years old. But again, mind-boggling. Year over year, the index is up over 20 or over 35%, and I can give you a preview for October, November, and very, very strong numbers. We've just not seen these before.
Interesting. Talking about things we haven't seen before. We spent a little time talking about this chart. What we're looking at is, well, let me let Mike explain it, but unprecedented performance here.
Yeah, this is looking at September on a month-over-month basis, and we run this chart out to year 2000. You can see typically anywhere, probably about 3 is a good number, 3 to 3.5% dip on a month-over-month basis. think about it. We're now in the fall season. We've had all the summer selling months over. It's back to school, and the fall starts to go,
soften a little bit.
Soften.
Yeah.
And as I tell people when I used to work at Hyundai, you got to remember there's winter in a lot of the parts of the country that we don't experience in Southern Cal. So things naturally slow down.
Yeah.
As Joe pointed out, unbelievable effect. Instead of the traditional 3% drop, we saw a 4% lift in sales. Again, as I said to Joe, really speaking to the lack of inventory out there. Dealers are buying cars. We've touched on the rental car companies not getting cars and their demand up, Joel, but I mean, they're making headlines. They're in the used car market looking for cars. I tell people, and it's anecdotal, but you'll hear this anecdotally 1,000 times. If you go put your car on Craigslist, Facebook Marketplace this weekend, for every 10 calls you get, 8 will be from an auto dealer.
Yeah, I believe it, and there'll be strong calls too.
Right. They're looking for inventory. They're looking for clean inventory that they can sell. Prices be damned as it gets scary. And I've talked to dealers of you paid what for what, but they've got to sell cars, and people still need cars.
We have a couple slides on the wholesale price performance, premium price performance, right. And then breaking it down to segment level. What are your big takeaways from these?
Really, pricing is strong across the board. There's really no outliers in there. You get some different movements. I think the headline is things like small car, compact car. Cars are coming back into vogue. While the transaction prices are up, we are starting to get into some more affordability issues out there. These SUVs and trucks are very pricey. So if you want something affordable, a 1 or 2 or 3-year-old, compact mid-sized car is a great value relative to that same model year SUV. They're pricey. I mean, it's pricey. So like anything else, they may not be the most popular segment, but they are an affordable segment. We're long past the age. What's an entry level car anymore? It's really a used car. You're well into close to $25,000 for an entry level new vehicle now.
Yeah, it's a little bit different than the Yugo for $39.90.
Yeah, no, absolutely, absolutely. And you got to remember too, when we look particularly at compact cars or things like that, a lot of the manufacturers have gotten out of that business. I mean, they're just no longer producing passenger cars. So, I mean, there is some demand. People still want passenger cars.
Yeah.
Yeah, but again, if you look across, just super strong numbers everywhere.
And I'm popping through to the auto finance origination data and insights, because this is where things are going to come together on both the used and the new market in terms of how are customers able to actually acquire these vehicles? Because an average, was it new or used? I thought it was what, 44,000 in that range. I mean, for most of us, you're going to need to finance the vehicle. And, what are the options that are out there for you? So we're looking at a slide with the new and used vehicle resale, retail sales by type.
Sure, Joel. And I just want to make sure your audience knows, when we look at new and used, the data we're presenting right now is from franchise new car dealers. This doesn't speak for the whole world of used cars. It probably does for new, but this is origination data that came from the franchise new car dealers.
But that is a meaningful point of view, right? Because you mentioned earlier, and it's obvious, right? If you're having problems acquiring inventory, sell some used vehicles, some units that maybe have lower mileage and are cleaner vehicles. And look, the table had already been set, right? People were really interested in what Carvana and other kind of spot delivery services can kind of give you. I think they like not have to haggle for the price and have some feeling like they're buying almost like a CPO, from those folks.
Exactly. So, and I think CarMax did a great job to start, but you've got others, like you said, as Carvana jumping into that space right there. So we don't have their data, but what we tell our clients is, this is all going to be directionally correct as we go through, whether we talk APRs or loan terms or things like that. There's not really outliers, whether a new car dealer did it or a used car dealer did it. It's going to be very, very similar. This first slide, Joel, just really speaks to what's the consumer's choice of financing. at a dealership, 80 some percent, 83% of all new vehicles sold on a retail basis are either financed or leased via the car dealer. We show in our data, we have a column there that says cash, but cash really signifies the dealer didn't finance it. We think about, or our data with TransUnion shows about 4% of new vehicle loans are from a direct lender, and about 9% on the used car side are direct or from a direct lending, with the balance being cash or cash equivalents right there.
Yeah.
Yep. But dealers are strong there. This is we segments and really, again, these charts get a little busy. Just some of the call outs. On the new car side, captives continue to have the largest share at almost 54%, up from 50% in 2019. And we use 2019 as a benchmark of normalcy before COVID, before chip shortages. So they're up, but down dramatically from 2020, when the generous quarter two low APR programs were going. I think your audience will remember to kind of kickstart the economy. They all came out with 0 for 84 and things like that, and really jumped in. A lot of 0 APR. We have a slide coming up in a second that speaks to that. On the used car side, captives have really fallen back to 2019 levels. For a while, they were doing more used car financing, but it was a function of generous CPO programs. The CPO programs' generosity as well as the volume are no longer there, so it's more of an open market. It's not being incentivized. Banks have rebounded, and banks really have taken back some of the captives' losses in there, and we can see. The banks clearly are the strongest in used cars, almost a 50% share. Credit unions, they're up on the new vehicle side, but still below 19 levels. Credit union share is holding steady at about 21% on used. The credit unions, up until through 2019, had a very, very strong showing, or 2018, but started to fall off a little bit. I think some of them dialed back to origination, and I think we've had some research and some larger banks in place right there. Independents, that would be your monoline, non-prime, primarily in there. They're steady. Their share remains steady on new, and they facilitate about 12% of the used car loans.
Yeah, banks and credit unions are showing some interest in this.
Yeah, Joe, we show this chart in there to talk about how much zero APR there was, and you could see when we looked at October, if the periods ran out, this is the spike that we saw last year. Jumping up in the first half of 17% of all new vehicle loans had an APR of 0. Compares only 5.4 in 2019 and 8% in 2018. We are seeing that subside. The manufacturers, quite frankly, with low levels of inventory, it cannot be as generous as to incentivize 0 APR loans.
That makes sense.
Yes.
Here we're looking at some new and used financing credit mix.
Yeah, here, Joel, we cut it. And the one data point that we don't get directly from the dealers, and that's credit scores. We partner up with TransUnion, and there's reasons why we don't get the credit scores from the dealers, partly because you can't reuse a credit score. But more importantly, there are 3 different credit bureaus, and the dealers are on different versions of each. So we use FICO 08, which is the most common credit score, FICO 08 auto. And so TransUnion refreshes all the credits, so we can do the stacking in there. We cut it into 4 tranches. I think you could say super prime, prime, non-prime, and then subprime with the 619 and below. Takeaways. In the last 2 years, we've seen, and again, this is a mix, Credit quality is increasing at the higher ends and falling. It's not fallen off the chart, but you can clearly see in 2019, subprime was about 10%. It's fallen to 7.4%. Used car, the story's a little bit different there. Similar to the 2019 numbers, a little movement between prime and super prime, but we don't see too much. Some non-prime pickup again within range. And relative to new car, used car subprime is holding steady, about 17%. And you can see that this time period, year to date, in 2019, it was 17.4. So it's holding pretty steady. Where we see the changes is higher levels of high quality credit, new lower levels of subprime credit.
Mm-hmm. Subprime's been contracting for a very long time.
Yep. The one chart that has not changed is terms, which continue to grow. We really saw, Joe, a large acceleration in 2020 when some of the larger manufacturers / captives introduced 84 months at zero. You had a number of captives that really weren't even providing 84-month loans, so they jumped in and clearly. Because A, they got in, and B, they had a lot of volume behind them. They really lifted the needle in there. We saw, for a matter of fact, in 2020, we saw 84-month loans at almost 30% of the marketplace on new. That's unprecedented. But again, speaking to primarily Ford, GM, and Chrysler Capital, Stellantis with their trucks and 84-month loans. But again, we see it steady, and it's really an affordability. I'll talk a little bit. We don't have portfolio data in here, but it's amazing how well these portfolios are performing for lenders. At Used Car Week, I talked about Q2 results were out. Q3 were starting to come out. You had large lenders who had a negative credit loss. For the quarter.
Yep. You got to cut checks because you repoed, the defaults actually garnered some overage.
Some recoveries. Yeah. The recoveries offset the losses. It was amazing.
Yeah.
So,
and that is even down to the smallest regional players. So, I try to stay in touch with as many lenders as I can. That is definitely the case in California here. I just moved to the slide on loan to value, and this is what we were talking about a little earlier.
Sure. This is one that's had some dramatic changes in here. And again, remember, we're mixing. So the sum, we sum up to 100% in here. It doesn't mean the aggregates are it's a little bit different. But we've seen the new and used car loan advances continue to moderate in there. In the 121 and up bucket for both new and used, it peaked in March of 2019 and is really, really falling. Ever since that's term, you can see it really falling off, and especially the highest advanced terms. And then I think you could draw your line. You could put it the other way, Joel, with the 90% and below. I mean, you can see that's the swap set right there.
Yep.
Again, you'll see those are probably more likely people that are trading in vehicles with good equities in them that can afford, or the stock market's been great. There's a number of factors out there. There's money out there. Probably more on the anecdotal side, but you've got a lot of folks in the last year where their travel budget has been greatly reduced, if not taken to zero. So buy a car.
Yeah.
Like that.
This is from a overall market risk standpoint. This is the most meaningful thing that we could do as operators is to control these loan to values. Because look, we know the wholesale values are up. I was astonished to hear that lenders are not having to pick up a lot of the weight on that. And dealers are still making profit. It's ultimately going out to the consumer. How do you make this happen? You extend the loan terms. I think this goes hand in hand with the extended loan terms. And having a lower LTV is going to give you a better quality portfolio.
Right. Absolutely. We're trending 2 full years plus the current. If we went back, Joel, 15 to 18, we would just see that 121 and up bucket just climbing dramatically.
Yeah.
This is you saw the first downward movement in the highest LTVs happen in 20, again with some cautionary. I think when it first started to tighten, it was lenders were afraid of the future. We sat in May of 20 wondering what used cars were going to be worth, if worth anything. Who knew? Was there going to be just a plethora of defaults because people aren't working? And clearly that didn't happen. But lenders have been cautious in that area. They're more apt to do term, but they're very much controlling the amount that they're financing.
Yeah. The pricing APRs have been kind of coming. They've been coming down across the board.
Yep. And point out to your listeners and readers online, Joel. We use non-captive rates. We don't want to muddy up pricing in there with 0% or 0.9 financing. So these are excluded. We call them non-captive rates. That would mean these rates are either from the banks, credit unions, independents, or they are the captives, non-Sabine rates. Probably a better way to say it right there. But you can see in all the credit buckets, they've been falling in the last year. We've seen thus far in 2021 on new vehicle about 36 basis point reduction. These are very, very attractive loans. Used, on the other hand, fell about 48 basis points. And the difference there is used is a lot more crowded. You saw banks have a 50% share, credit unions have a 20-some% share. That's a more competitive landscaping out there. And I think, as many folks on the call know, as a lender, there's two ways to get business. It's rate and risk. And folks really don't want to do risk right now. So it's very competitive on the rate side. And as Joel just circled that on their really competitive forces, at this writing, and I think we still believe for the balance of the year, the Fed is taking a more moderate stance. We'll see in the last, inflation came out again today at 6%. Last month we saw it at 6%. Does that make the Fed make a movement sooner rather than later? But interestingly enough, if your listeners look at the bond market, the 10 years and like, they're pretty stable right now. We're not seeing, and as I tell people, the Fed doesn't set auto rates, the market sets the rates, and the market is really not moving up too high.
So now we're bringing it down to a conclusion. This is our overall conclusion, Michael.
Yeah. For the auto finance outlook, I think key point, very, very positive for lenders. The anticipated levels of COVID losses never materialize, and that's a huge thing. I get asked sometimes, especially Joel, when we got in those rough periods, lenders will hold off on originations. They worry about portfolios. That's a big driver, and they'll get originations later. But the house is in order. It's very, very good. The volumes have come back strong. We do see, and again, I see a typo, Q4 have some challenges due to inventory. You can only finance what's out there. Captive share has fallen in 21, but still remains higher than historical. Banks, as we talked before, have come back on strong with lower APR programs from the captives and CPO programs. So it's more of an open market. They are credit union flat and stable. Independents, they bottomed out in 20, but they've come back. Leasing fallen to 25. We don't see much movement in either direction. We did see some downfalls in October and November. Below that, we're going to show November about 21%, but more so a function of availability of inventory. And that's the hard part to calculate. The manufacturers aren't feeding us with their inventory of inbound. We know what's on the ground. We don't know, what they're producing right now. And then lastly, the credit quality remains stable. LTVs are lower than pre-COVID. Strong used cars value have really helped to keep them lower. And pricing, while near historical lows, is forecast to be stable throughout the year. So it's really, really a great time. I would say the two cautionary pieces for the lenders are, how much inventory do the dealers have that I can finance? And I think that's probably the biggest one in there. On the swap set, the portfolios are looking very, very good. And there is, again, tightening on pricing. I think probably all the lenders out there would love to be charging a little bit more, but the competitive market won't let them do that.
Mike, do you get a lot of questions from from operators saying, okay, I'm actually cutting checks for these recoveries because I'm recovering the full value.
Sure.
That's a good thing, but sure, I'm having to really pay a pretty penny, a premium, if you will, relative for my new originations. And so that's a cash drain. So if I had 100 units that rolled off my portfolio, I may not be able to originate another 100 units. It may be like 60, maybe 80.
Sure.
How do I not get over my skis? And how do I, purchase vehicles today at this premium pricing without thinking in that 42 or whatever your loss curves, when things start really picking up, how do I keep myself from catching a falling knife?
Yeah, I think you just got to be diligent in your originations, and not be tempted to overreach with credit. I think pricing. Everybody has a floor that they can be at, but I think and you've got to moderate. We're gonna see some changes. Inventory will pick up. These prices are going to get normal. I think. To some folks, Joe, you've got to sit, do I kind of sit on the sidelines a little bit and think this over and take a pause?
Maybe originate at a lower level and replenish the portfolio once the market conditions change.
Exactly. And I think, a few years ago when subprime heated up, we saw a number of the lenders said, basically, I'm not chasing the market anymore.
Yeah.
Volume be damned. We've got to, whether it's our shareholders, our investors, or whatever, we just have to tell them we're not comfortable at these levels and that we may need to moderate volume until a more rational market exists. There is, for the most part, rationality in there. No one is off the charts on risk, but pricing is very, very thin. And you've got to remember, in a marketplace like this, you've got the banks that can really get cheap funds out there, and what are their hurdle rates? Clearly, Joe, you can be in competition with somebody that says, I just need to keep my people working, just like the manufacturers used to be for the autos. They knew they weren't making any money on cars, but they got to keep the plants running. So, you've got to assess your own situation and not chase things. Don't do unnatural acts.
So for folks that were just listening, look, you can do I used to listen to these little records, and then you would have a book that kind of accompanied it when I was a kid. I thought they were great. Now you just watch a show. But if you're listening, you want to get a copy of the deck, michael.buckingham@jdpa.com. Michael is the managing director of auto finance at JD Power. Thanks so much for being on the podcast today. And, I hope folks do reach out. And if you're watching or listening to this on YouTube, you can see the whole thing with the slides. I did my best to try to carry it through and make it interesting and engaging. Michael, this is great. I would love to have you back on when we get some updates. How does that sound?
We'll figure some time, maybe early in the first quarter, we can do a recap, or, Joe, every month changes. There's interesting dynamics going on. Just when you thought we couldn't get any lower or higher, we seem to do.
This is so important to our ecosystem, getting this data and information out there. I thank you and the JD Power team.
You're welcome. Very welcome, Joe. Thank you all for listening.